Compromise and tax amnesty. Compromise is a contract whereby the parties, by reciprocal concessions, avoid litigation or put an end to one already commenced. It implies the mutual agreement by the parties in regard to the thing or subject matter which is to be compromised. Compromises are generally allowed and enforceable when the subject matter thereof is not prohibited from being compromised and the person entering such compromise is duly authorized to do so. Persons allowed to enter into compromise of tax obligations. The law allows following persons to do compromise in behalf of the government. BIR Commissioner, as expressly authorized by the NIRC and subject to the following conditions. A. When a reasonable doubt as to validity of the claim against the taxpayer exists, or B. The financial position of the taxpayer demonstrate a clear inability to pay the assessed tax. Section 204, letter A, NIRC. Number 2, Collector of Customs. With respect to custom duties limited to cases where the legitimate authority is specifically granted, such as in the remission of duties. Section 709 TCC. 3. Customs Commissioner. Subject to the approval of the Secretary of Finance in cases involving the imposition of fines, surcharges, and forfeitures. Section 2316 TCC. Tax Amnesty. Being a general pardon or intentional overlooking by the state of its authority to impose penalties on persons otherwise guilty of evasion or violation of a revenue or tax law. It partakes of an absolute waiver by the government of its right to collect what is due it and to give tax evaders who wish to relent a chance to start with a clean slate. HR International Auctioneers versus CAR. A tax amnesty, much like a tax exemption, is never favored or presumed in law. The grant of a tax amnesty, similar to a tax exemption, must be construed strictly against the taxpayer and liberally in favor of the taxing authority. H. International Auctioneers versus CAR. Tax amnesty distinguished from tax exemption. Scope of immunity under tax amnesty: immunity from all criminal, civil, and administrative obligations arising from non-payment of taxes. Tax exemption: immunity from civil liability. Grantee under tax amnesty: general pardon given to all erring taxpayer. Tax exemption: a freedom from a charge of or burden to which others are subjected. How applied? Tax amnesty applied retroactively. Tax exemption applied prospectively. Presence of actual revenue loss. Tax amnesty: there is revenue loss since there was actually taxes due but collection was waived by the government. Tax exemption: none, because there was no actual taxes due, as the person or transaction is protected by tax exemption. Does the mere filing of tax amnesty returns shield the taxpayer from immunity against prosecution? Answer: no. The taxpayer must have voluntarily disclosed his previously untaxed income and must have paid the corresponding tax on such previously untaxed income. People versus Judge Castaneda. Can a taxpayer claim tax amnesty if he is a withholding tax agent? The claim of taxpayer under a tax amnesty shall be allowed when the liability involves the deficiency in payment of income tax. However, it must be disallowed when the taxpayer is assessed on his capacity as a withholding tax agent because the person who earned the taxable income was another person other than the withholding agent. LG Electronics Philippines versus CAR. The BIR assessed garments company deficiencies on taxes for non-payment of VAT on its undeclared sales. While the case was pending before the Supreme Court, Garment Company filed a manifestation in motion that it had availed and was able to comply with the government's tax amnesty program under the 2007 Tax Amnesty Law. However, BIR contends that Garment Company is disqualified per BIR RMC 19/2008, or a basic guide on the Tax Amnesty Act of 2007, which disqualifies taxpayer with issues and cases that were ruled by any court even without finality in favor of the BIR prior to amnesty availment of the taxpayer. Did Garment Company qualify for the tax amnesty program? Answer: yes. While tax amnesty, similar to a tax exemption, must be construed strictly against the taxpayer and liberally in favor of the taxing authority, it is also a well-settled doctrine that the rulemaking power of administrative agencies cannot be extended to amend or expand statutory requirements as to embrace matters not originally encompassed by the law. Administrative regulations should always be in accord with the provisions of the statute they seek to carry into effect, and any resulting inconsistency shall be resolved in favor of the basic law. Thus, BIR RMC 19-2008 is invalid as the exception goes beyond the scope of the provisions of the 2007 tax amnesty law. CS Garment versus CS CIR. Taxpayer's suit. It is a case where the act complained of directly involves the illegal disbursement of public funds collected through taxation. In the case of Abaya versus Ebdane, the prevailing doctrine in the taxpayer's suit is 1. To allow the taxpayer to question contracts entered into by the national government or government-owned and controlled corporations, allegedly in contravention of law. 2. To allow the taxpayer to sue when there is a claim that public funds are illegally disbursed or public money is being deflected to any improper purpose, or that the wastage of public funds through the enforcement of an invalid or unconstitutional law. 3. Significantly, a taxpayer need not be a party to the contract to challenge its validity. A taxpayer is allowed to sue where there is a claim that public funds are illegally disbursed, or that public money is being deflected to any improper purpose, or that there is wastage of public funds through the enforcement of an invalid or unconstitutional law. Land Bank of the Philippines versus Kakayuran. A taxpayer's suit is proper only when there is an exercise by the Congress of its spending or taxing power. Taxpayer's suit distinguished from a citizen's suit. The plaintiff in a taxpayer's suit is in a different category from the plaintiff in a citizen's suit. In the former, the plaintiff is affected by the expenditure of public funds, while in the latter, he is but the mere instrument of the public concern. David versus Macapagal Arroyo. In the case of taxpayer's suit, plaintiff is allowed to sue where there is a claim that public funds are illegally disbursed, or that public money is being deflected to any improper purpose, or that there is a wastage of public funds through the enforcement of an invalid or unconstitutional law. Francisco Jr. versus nagmamalasakit na mga manananggol. In a citizen's suit, the interests of the petitioner assailing the constitutionality of a statute must be direct and personal. He must be able to show not only that the law or any government act is invalid, but also that he sustained or is in imminent danger of sustaining some direct injury as a result of its enforcement, and not merely that he suffers thereby in some indefinite way. It must appear that the person complaining has been or is about to be denied some right or privilege to which he is lawfully entitled, or that he is about to be subjected to some burdens or penalties by reason of the statute or act complained of. Francisco Jr. versus nagmamalasakit na mga manananggol. Two requisites of a taxpayer's suit. 1. Public funds derived from taxation are disbursed by a political subdivision or instrumentality, and in doing so, a law is violated or some irregularity is committed. And, note, a taxpayer's suit would fail if what are alleged to be illegally disposed of are objects which were acquired from private sources. Joy et al. Versus PCGG. 2. The petitioner is directly affected by the alleged act. Through EO number 30, the President created a trust for the benefit of the Filipino people under the name and style of the CCP. The trust was to undertake the construction of a national theater and music hall to awaken the nation's consciousness on cultural heritage and to promote, preserve, and enhance the same. Pursuant thereto, CPP's Board of Trustees received foreign donations and financial commitments. Petitioner, however, claims that in issuing EO number 30, there was an encroachment by the President on the legislative's prerogative to enact laws. The trial court dismissed the petition on the ground that Gonzales did not have the personality to question the issuance of EO number 30, since the funds administered by said CCP came from donations, without a single centavo raised by taxation. Does the petitioner have the personality to question the validity of EO number 30 based on a taxpayer's suit? Answer: no. Gonzales did not meet the requisite burden to warrant the reversal of the trial court decision. It was pointed out therein that one valid reason why such an outcome was unavoidable was that the funds administered by the center came from donations and contributions and not from taxation. Accordingly, there was an absence of the pecuniary requisite of monetary interest. Gonzales has not satisfied an element for a taxpayer's suit. Gonzales versus Marcos. Q. In 1982, the COA issued Circular Number 82195, lifting the system of pre-audit of government financial transactions. After the change in administration due to the 1986 revolution, grave irregularities and anomalies in the government's financial transactions were uncovered. Hence, on March 1986, the COA issued Circular Number 86257, which reinstated the pre-audit of selected government transactions with the normalization of the political system of the stabilization of government operations. The COA saw it fit to issue Circular Number 89299, which again lifted the pre-audit of government transactions of national government agencies (NGAs) and government-owned or controlled corporation (GOCCs). Petitioner filed this petition for certiorari under Rule 65, alleging that the pre-audit duty on the part of the COA cannot be lifted by a mere circular, considering that the pre-audit is a constitutional mandate enshrined in Section 2 of Article 9D of the 1987 Constitution. He further claims that because of the lack of pre-audit by COA, serious irregularities in government transactions have been committed. The petition has been filed a taxpayer suit. Is he entitled to the extraordinary writ of certiorari? Answer: yes. A taxpayer is deemed to have the standing to raise a constitutional issue when it is established that public funds from taxation have been dispersed in alleged contravention of the law or the Constitution. Petitioner claims that the issuance of Circular Number 89299 has led to the dissipation of public funds through numerous irregularities in government financial transactions. These transactions have alleged been left unchecked by the lifting of the pre-audit performed by COA, which petitioner argues is its constitutional duty. Thus, petitioner has standing to file this suit as a taxpayer, since he would be adversely affected by the illegal use of public funds. De La Lana versus COA. Locus standi. The party suing as a taxpayer must prove that he has sufficient interest in preventing the illegal expenditure of money raised by taxation. Thus, taxpayers have been allowed to sue where there is a claim that public funds are illegally dispersed, or that public money is being deflected to any improper purpose, or that public funds are wasted through the enforcement of an invalid or unconstitutional law. The taxpayer must establish that 1. He has a personal and substantial interest in the case, and 2. He has sustained or will sustain direct injury as a result of its enforcement, or that he stands to be benefited or injured by the enjudgment in the case, or is entitled to the avails of the suit. Public Interest Center versus Rojas. Note: being a mere procedural technicality, the requirement of locus standi may be waived by the court in the exercise of its discretion. David versus Macapagal Arroyo. Doctrine of transcendental importance. The following determines the importance of transcendental importance. 1. The character of the funds or assets involved in the case. 2. The presence of a clear case of disregard of a constitutional or statutory prohibition by the public respondent agency or instrumentality of the government. 3. The lack of any other party with a more direct and specific interest in raising the questions being raised. Creba versus Irk, 624 Squad 556. In the exercise of its discretion, the court may brush aside these technicalities and take cognizance of the petition, considering the transcendental importance to the public of the case, and in keeping with the duty to determine whether the other branches of the government have kept themselves within the limits of the Constitution. Coconut Oil Refiners versus Torres, GR 132527. Ripeness for a judicial determination. The constitutional question is ripe for adjudication when the government's act being challenged has a direct adverse effect on the individual challenging it. Personal injury or benefit must be shown for judicial controversy to be ripe for judicial determination. Note, however, where the public interest requires the resolution of the constitutional issues raised by the taxpayer, the doctrine of ripe for judicial determination is within the court's discretion to set aside. Abacada Guru Party List versus Purissima. This doctrine is similar to that of exhaustion of administrative remedies, except that it applies to the rulemaking and to administrative action which is embodied neither in rules and regulations nor in adjudication or final order. It is applicable when the interest of the plaintiff is subjected to or imminently threatened with substantial injury. If the statute is self-executing, when a party is immediately confronted with the problem of complying or violating a statute and there is a risk of criminal penalties, or when plaintiff is harmed by the vagueness of the statute. Vix. whatever that VIX means. Organization and functions of the Bureau of Internal Revenue. Rulemaking authority of Secretary of Finance. The Secretary of Finance, upon recommendation of the Commissioner, shall promulgate all needful rules and regulations for the effective enforcement of the provisions of NIRC. C. 244 NIRC. General principles of the rulemaking power. 1. Rules and regulations as well as administrative opinions and rulings ordinarily should deserve weight and respected by the courts. 2. All such issuances must not override but must remain consistent and in harmony with the law they seek to apply and implement. 3. Administrative rules and regulations are intended to carry out, neither to supplant nor to modify the law. CIR versus CAGR 108358. Specific provisions to be contained in rules and regulations. Rules and regulations must contain provisions specifying, prescribing, or defining 1. The time and manner in which Revenue Regional Directors shall canvass their respective revenue regions to discover persons and property liable to national internal revenue taxes, and the manner their list and records of taxable persons and taxable objects shall be made and kept. 2. The forms of labels, brands, or marks to be required on goods subject to excise tax, and the manner how the labeling, branding, or marking shall be effected. 3. The condition and manner for goods intended for export, which, if not exported, would be subject to an excise tax, shall be labeled, branded, or marked. 4. The conditions to be observed by revenue officers respecting the institutions and conduct of legal actions and proceedings. 5. The conditions under which goods intended for storage in bonded warehouses shall be conveyed thither. Their manner of storage and method of keeping entries and records. Also the books to be kept by revenue inspectors and the reports to be made by them in connection with the supervision of such houses. 6. The conditions under which denatured alcohol may be removed and dealt in, the character and quantity of the denaturing materials to be used, the manner in which the process of denaturing shall be effected, so as to render the alcohol suitably denatured and unfit for oral intake, the bonds to be given, the books and records to be kept, the entries to be made therein, the reports to be made to the CIR, and the signs to be displayed in the business or by the person for whom such denaturing is done, or by whom such alcohol is dealt in, the manner in which revenue shall be collected and paid, the instrument, document, or objects to which revenue stamps shall be affixed, the mode of cancellation, the manner in which the proper books, records, invoices, and other papers shall be kept, and entries therein made by the person subject to the tax, as well as the manner in which licenses and stamps shall be gathered up and returned after serving their purposes. 8. The conditions to be observed by revenue officers respecting the enforcement of Title III imposing a tax on estate of a decedent and other transfers mortis causa, as well as on gift and such other rules and regulations which the CIR may consider suitable for the enforcement of the said Title III. 9. The manner tax returns, information, and reports shall be prepared and reported, and the tax collected and paid, as well as the conditions under which evidence of payment shall be furnished to taxpayer, and the preparation and publication of tax statistics. Number 10. The manner in which internal revenue taxes, such as income tax, including withholding tax, estate and donors tax, value-added tax, other personage taxes, excise taxes, and documentary stamp taxes, shall be paid to the collection officers of the BIR or through duly authorized agent banks, which are hereby deputized to receive payments of such taxes, and the returns, papers, and statements that may be filled by the taxpayers in connection with the payment of the tax, provided, however, that notwithstanding the other provisions of the NIRC prescribing the place of filing of returns and payments of taxes, the CIR may by rules and regulations require that the tax returns, papers, and statements and taxes of large taxpayers be filed and paid, respectively, through collection officers or through duly authorized agent banks, provided further that the CIR can exercise this power within 6 years from the approval of RA 7646 or the completion of its comprehensive computerization program, whichever comes earlier, provided finally that separate venues for the Luzon, Visayas, and Mindanao areas may be designated for the filing of tax return and payment of taxes by said large taxpayers. Large taxpayers. A taxpayer is anyone who satisfies any of the following criteria. 1. For VAT, business establishment with VAT paid or payable at least 100,000 for any quarter of the preceding taxable year. Number 2. For excise tax, business establishment with excise tax paid or payable at least 1 million for the preceding taxable year. 3. For corporate income tax, business establishment with annual income tax paid or payable at least 1 million for the preceding taxable year. And 4. For withholding tax, business establishment with withholding tax payment or a remittance of at least 1 million for the preceding taxable year. Provided, however, that the Secretary of Finance, upon recommendation of the CIR, may modify or add to the above criteria for determining a large taxpayer after considering such factors as inflation, volume of business, wage and employment levels, and similar economic factors. The penalties prescribed under Section 248 of the NIRC shall be imposed on any violation of the rules and regulations issued by the Secretary of Finance upon recommendation of the CIR prescribing the place of filing of returns and payments of taxes by large taxpayers. 245 NIRC. Jurisdiction, power, and functions of the Commissioner of Internal Revenue. Powers and duties of the BIR. 1. Assessment and collection of all national internal revenue taxes, fees, and charges. 2. Enforcement of all forfeitures, penalties, and fines. 3. Execution of judgment in all cases decided in its favor by the CTA and regular courts. 4. Give effect and administer the supervisory and police powers conferred to it by the NIRC and other laws. 5. Recommend to the Secretary of Finance all needful rules and regulations for the effective enforcement of the provision of the NIRC. Chief Officials of the BIR. The BIR is headed by the CIR and 6 Deputy Commissioners who lead the following divisions. 1. Operations Group. 2. Legal Inspection Group. 3. Resource and Management Group. 4. Information Systems Group. 5. Prosecution Group. 6. Special Concerns Group. Q. Is the BIR authorized to collect state tax deficiencies by the summary remedy of levy upon the sale of real properties of the decedent without first securing the authority of the court sitting in probate over the supposed will of the decedent? 1998 FAR. Answer: yes. The BIR is authorized to collect a state tax deficiency through the summary remedy of levying upon and sale of real properties of the decedent without the cognition and authority of the court sitting in probate over the supposed will of the deceased, because of the collection of estate tax is executive in character. As such, the estate tax is exempted from the application of the statute of non-claims, and this is justified by the necessity of government funding, immortalized in the maxim that taxes are the lifeblood of the government. Marcus versus CIR. Powers of the Commissioner. 1. Power to interpret tax laws and to decide cases. Section 4 of the NIRC. Number 2. Power to obtain information and to summon, examine, and take testimony of persons. Section 5 NIRC. What are the purposes of these powers? A. To ascertain or answer to ascertain correctness of the return. 2. To make return when none has been made. 3. To determine liability of any person for any internal revenue tax. 4. To collect such liability. 5. To evaluate tax compliance. Q. What is the scope of such powers? A. To examine any book, paper, record, or other data which may be relevant or material to such inquiry. 2. To obtain any information, costs, volume of production, receipts, sales, gross income, on a regular basis from any person other than the person under investigation in any office or officer of the national or local government. 3. To summon the following to produce records and to give testimony. A. The person liable for tax or required to file a return. B. Any officer or employee of such person. C. Any person having in his possession, custody, and care the books of accounts, accounting records of entries related to the business of such taxpayer. Number 3. Power to make assessment and prescribe additional requirements for tax administration and enforcement. That is Section 6 NIRC. Number 4. Power to assign internal revenue officers and other employees. Section 16 and 17 NIRC. 5. Power to suspend the business operation of a taxpayer for violation of VAT rules. Section 115 NIRC. When can the CIR suspend the business operation of a taxpayer? Answer. In the case of VAT registered person. A. Failure to issue receipts or invoices. B. Failure to file a VAT return as required under Section 114. Or C. understatement of taxable sales or receipts by 30% or more if it's correct taxable sale, or receipts of the taxable quarter. Number 2, failure of any person to register as required under Section 236. The temporary closure of the establishment shall be for the duration of not less than 5 days and shall be lifted only upon compliance with whatever requirements prescribed by the CIR in the closure order, Section 115 NIRC. The CIR is also authorized to terminate taxable period for reason provided in the NIRC, to make or amend return in case taxpayer fails to file a return or files a false or fraudulent return, to examine returns and determine tax due, to prescribe any additional requirements for the submission or preparation of financial statements accompanying tax returns. 5. To inquire into bank deposits of a decedent to determine his gross income, a taxpayer who filed application to compromise payment of tax liability by reason of financial incapacity, a specific taxpayer or taxpayer subject to a request for the supply of tax information from a foreign tax authority pursuant to an international convention or agreement on tax matter to which the Philippines is a signatory or a party of, provided that the information obtained from the banks and other financial institutions may be used by the BIR for tax assessment, verification, audit, and enforcement purposes. To delegate powers vested upon him to subordinate officials with rank equivalent to division chief or higher, subject to limitations and restrictions imposed under the rules and regulations. 7. To prescribe real property values. 8. To take inventory of goods of any taxpayer and place any business under observation or surveillance if there is reason to believe that such is not declaring his correct income, sales, or receipts for tax purposes. To register tax agents. What are the power of the BIR which cannot be delegated? BRICA. Answer. To recommend promulgation of rules and regulations by the Secretary of Finance, that is R. To issue rulings of first impression to reverse, revoke, or modify any existing rule of the BIR, that is I. General rule. To compromise or abate any tax liability. Exception. The Regional Evaluation Board may compromise assessments involving deficiency taxes of 500,000 or less and minor crime violations. Number 4A. To assign or reassign internal revenue officers to establishment where articles subject to excise tax are kept. Q. Will errors or mistakes of administrative officials bind the government as to the collection of taxes? General rule. Errors or mistake of administrative officials, including the BIR, should never be allowed to jeopardize the financial position of the government. Reason. Taxes are the lifeblood of the nation through which the government agencies continue to operate and with which the state effects its function for the welfare of its constituents. CIR versus City Trust. Exception. For the purpose of safeguarding taxpayers from any unreasonable examination, investigation, or assessment, our tax law provides a statute of limitations in the collection of taxes. Thus, the law on prescription, being a remedial measure, should be liberally construed in order to afford such protection. As a corollary, the exception to the law on prescription should perforce be strictly construed. As corollary, the exceptions to the law on prescription should perforce be strictly construed. TIR versus Goodrich, Philippines. Note, in the City Trust case, which involves a claim for a refund, the error or neglect was the failure of the Solicitor General to present its evidence as counsel for the CIR due to the unavailability of the necessary records from BIR, prompting the solicitor to submit the case for decision without presenting any evidence. While in Goodrich, the error committed refers to the neglect of the BIR to make assessment within the 3-year period as required in Section 203 NIRC. Powers of the Commissioner to interpret tax laws and to decide tax cases. The power to interpret the provisions of NIRC and other tax laws shall be under the exclusive and original jurisdiction of the Commissioner, subject to review by the Secretary of Finance. The power to decide disputed assessment, refunds of internal revenue taxes, fees, or other charges, penalties imposed in relation thereto, or other matters arising under the NIRC or other laws or portions thereof, administered by the BIR is vested in the Commissioner, subject to the exclusive appellate jurisdiction of the Court of Tax Appeals. Power to interpret. A. The NIRC and other tax laws. power to decide on a disputed assessment, refunds of internal revenue taxes, fees or other charges and penalties imposed in relation thereto, other matters arising under the NIRC or other laws or portions thereof administered by the BIR. Non-retroactivity of rulings. The rulings of the BIR are not retroactive, and a revocation, modification, or reversal of any of the rules and regulations promulgated or any of the rulings or circulars promulgated by the CIR shall not be given retroactive application if it will be prejudicial to the taxpayer, except in the following cases. 1. Where the taxpayer deliberately mistrusts or omits material facts from his return or any document required of him by the BIR. 2. Where the facts subsequently gathered by the BIR are materially different from the facts on which the ruling is based. Or 3. Where the taxpayer acted in bad faith. Section 246 NIRC. Note: if the revocation is due to the fact that the regulation is erroneous or contrary to law, such revocation shall have retroactive operation as to affect past transactions, because a wrong construction of the law cannot give rise to a vested right that can be invoked by a taxpayer. Q. XYZ Corporation, an export-oriented company, was able to secure a BIR ruling in June 2005 that exempts from tax the importation sum of its raw materials. The ruling is of first impression, which means that the interpretation made by the Commissioner of Internal Revenue is one without established precedents. Subsequently, however, the BIR issued another ruling which in effect would subject to tax such kind of importation. XYZ Corporation is concerned that said ruling may have a retroactive effect, which means that all their importations done before the issuance of the second ruling could be subject to tax. A. What is the BIR ruling? B. What is required to make a BIR ruling of first impression a valid one? C. Does the first ruling have a retroactive effect, considering the principle that tax exemptions should be interpreted strictly against the taxpayer? Answer. Answer. A BIR ruling is an administrative interpretation of the revenue law as applied and implemented by the Bureau. They can be relied upon by taxpayers and are valid until otherwise determined by the courts or modified or revoked by a subsequent ruling or opinion. They are accorded great weight and respect, but not binding on the courts. What? Commission versus Ledesma. A. A BIR ruling of first impression to be valid ruling must be issued within the scope of authority granted to the Commissioner of Internal Revenue and not contravene any law or decision of the Supreme Court. CIR versus Michelle Luller, Pawn Shop. B. Ruling cannot be given retroactive effect if it would be prejudicial to the taxpayer. Section 246 of the NIRC provided for retroactive effect in the following cases. 1. Where the taxpayer deliberately misstates or omits material facts from his return or any document required of him of the BIR. Where the facts subsequently gathered by the BIR are materially different from the facts on which the ruling is based, or where the taxpayer acted in bad faith. Q. Due to an uncertainty whether or not a new tax law is applicable to printing companies, DEF Printers submitted a legal query to the BIR on that issue. The BIR issued a ruling that printing companies are not covered by the new law. Relying on this ruling, DEF Printers did not pay said tax. Subsequently, however, the BIR reversed the ruling and issued a new one stating that the tax covers printing companies. Could the BIR now assess DEF Printers for back taxes corresponding to the years before the new ruling? Reason briefly. Answer is no. Reversal of a ruling shall not be given a retroactive application if said reversal will be prejudicial to the taxpayer. Therefore, the BIR cannot assess DEF Printers for back taxes because it would be violative of the principle of non-retroactivity of rulings, and doing so would result in grave injustice to the taxpayer who relied on the first ruling in good faith. Section 246. Income taxation. Definition, nature, and general principles. Income taxation is in the nature of an excise taxation system or taxation on the exercise of privilege. The privilege to earn yearly profits from various sources. It is a system that does not provide for the taxation of property. Dumondon 2013 Income Tax System. Global tax system. System employed where the tax system views indifferently the tax base and generally treats in common all categories of taxable income of the individual. Tan versus Del Rosario. I don't understand that. Global tax system. System employed where the tax system views indifferently the tax base and generally treats in common all categories of taxable income of the individual. 2. Schedular tax system. System employed where the income tax treatment varies and is made to depend on the kind of category of taxable income of the taxpayer. 3. Semi-schedular or semi-global tax system. All compensation, income, business or professional income, capital gain, passive income, and other income not subject to final tax are added together to arrive at the gross income. After deducting the allowable deductions and exemptions from the gross income, the taxable income is subjected to one set of graduated tax rate, individual, or normal corporate income tax rate, corporation. Schedular treatment versus global treatment. Schedular treatment, different tax rate, different categories of taxable income, usually used in the income taxation of individuals. Business income, professional income, passive income, illegal income, you cannot add all of them together. Global treatment, unitary or single tax rate, no need for classification as all taxpayers are subjected to a single rate applied to corporations. Business income, professional income, passive income, illegal income, all of them will be added together and be subjected to one tax rate. All right. Features of the Philippines income tax law. Direct tax. Tax burden is borne by the income recipient upon whom the tax is imposed. It is a tax demanded from the very person who it is intended or desired should pay it, while indirect tax is a tax demanded in the first instance from one person in the expectation and intention that he can shift the burden to someone else. Progressive tax. The tax base increases as the tax rate increases. It is founded on the ability to pay principal. Comprehensive. It adopted the citizenship principle, the residence principle, and the source principle. Semi-schedular or semi-global tax system. Criteria in imposing Philippine income tax. Citizenship or nationality principle. A citizen of the Philippines is subject to Philippine income tax on his worldwide income if he resides in the Philippines, only on his Philippine source income if he qualifies as a non-resident citizen. Number 2, residence or domicile principle. A resident alien is liable to pay Philippine income tax on his income from sources within the Philippines, but is exempt from tax on his income from sources outside the Philippines. Source principle. An alien is subject to Philippine income tax because he derives income from sources within the Philippines. A non-resident alien or non-resident foreign corporation is liable to pay a Philippine income tax on income from sources within the Philippines, despite the fact that he has not set foot in the Philippines. Types of Philippine income tax. 1. Minimum corporation income tax, MCIT. Capital gains tax on sale or exchange of unlisted shares of stocks of a domestic corporation classified as a capital asset. 3. Capital gains tax on sale or exchange for real property located in the Philippines classified as capital asset. 4. Final withholding tax on certain passive investment incomes. 5. Final withholding tax on income payments made to non-resident individual or corporation. 6. Fringe benefit tax. 7. Branch profit remittance tax. 8. Improperly accumulated earnings tax. 9. Normal corporate income tax on corporations. 10. Graduated income tax on individuals. 11. Special income tax on certain corporations. Taxable period. Taxable period is the calendar year or the fiscal year ending during such calendar year, upon the basis of which the net income is computed for income tax purposes. Kinds of taxable periods. 1. Calendar period. The 12 consecutive months starting on January 1 and ending on December 31. Instances when calendar year shall be the basis of computing net income. 1. When the taxpayer is an individual. 2. When the taxpayer does not keep books of account. 3. When the taxpayer has no annual accounting period. 4. When the taxpayer is an estate or a trust. Note, taxpayers other than a corporation are required to use only the calendar year. Fiscal period. It is a period of 12 months ending on the last day of any month other than December. Note, the final adjustment return shall be filed on or before the 15th day of April or on or before the 15th day of the fourth month following the close of the fiscal year, as the case may be. Short period. General rule, the taxable period, whether it is a calendar year or fiscal year, always consists of 12 months. Exception. Instances when the taxpayer may have a taxable period of less than 12 months. 1. When the corporation is newly organized and commenced operation on any day within the year. When the corporation changes its accounting period. When a corporation is dissolved. When the Commissioner of Internal Revenue by authority terminates the taxable period of a taxpayer. 5. In case of final return of the decedent and such period ends at the time of his death. Kinds of taxpayers. Individuals. A. Citizen, resident citizen, RC. Non-resident citizen, NRC. Aliens, resident alien, RA. Non-resident alien, NRA. Engage in trade or business, NRA, ETB. Engage in trade or business. Not engage in trade or business, NRA and ETB. Special aliens. C. Special class of individual employees, minimum wage earner. Corporation, domestic foreign, resident foreign corporation, RFC, non-resident foreign corporation, non-resident foreign NRFC, joint venture and consortium. 3. Partnerships. 4. General professional partnerships. 5. Estates and trust. 6. Co-ownerships. Importance of knowing the classification of taxpayers in order to determine the applicable GREED. 1. Gross income. 2. Income tax rates. 3. Exclusions from gross income. 4. Exemptions. 5. Deductions. Income tax. Income tax is a tax on all yearly profits arising from property, profession, trade, or business, or a tax on person's income, emoluments, profits, and the like. Fisher versus Trinidad. It is generally regarded as an excise tax. It is not levied upon persons, property, funds, or profits, but on the privilege of receiving said income or profit. Purposes of income tax: to provide large amount of revenue, to offset regressive sales and consumption tax, to mitigate the evils arising from the inequality in the distribution of income and wealth which are considered deterrents to social progress by a progressive scheme of taxation. Madrigal versus Rafferty. State partnership theory. It is the basis of the government in taxing income. It emanates from its partnership in the production of income by providing the protection, resources, incentive, and proper climate for such production. CIR versus Lednicki. Income tax versus property tax. Basic incidence. Income tax. The incidence of the income tax falls on the earner. Under property tax, the incidence of the property tax is on the property itself. Who pays the tax? Income tax, the earner pays the income. Property tax, the owner of the property pays the property tax. How measured? Income tax is measured by the amount of income received over a period of time. Property tax is measured by the value of the property at the particular date. Frequency of taxation. Income tax is taxed only once. Property may be taxed on a recurrent basis. General principles, except when otherwise provided in the NIRC. Number 1. A resident citizen is taxable on all income derived from sources within and without. A non-resident citizen is taxable only on income derived from sources within. An individual citizen who is working and deriving income from abroad or as an overseas contract worker is taxable only on income from sources within. An alien or a non-resident alien is taxable only on income within. A domestic corporation, DC, is taxable on all income derived within and without. A foreign corporation engaged or not in trade or business in the Philippines is taxable only on income derived from sources within. Income. Income refers to all wealth which flows into the taxpayers other than as mere return of capital. It includes the forms of income specifically described as gains and profits, including gains derived from the sale or other disposition of capital assets. An income is an amount of money coming to a person or corporation within a specified time, whether as payment for service, interest, or profit from investment. Unless otherwise specified, income means cash or its equivalent. Conwy versus CIR. Income is a flow of service rendered by capital by payment of money from it or any benefit rendered by a fund or capital in relation to such fund through a period of time. Madrigal versus Rafferty. Income versus capital. Capital constitutes the investment which is the source of income. It is the wealth. It is the tree. It is fund. Return of recovery of capital is not subject to income tax. Income. Any wealth which flows into the taxpayer other than a mere return of capital. Is the service of wealth. Is the fruit. Flow. Income is subject to income tax. Madrigal versus Rafferty. Objects being taxed in income taxation: fruit of capital, fruit of labor, and capital combined. Assuming Mr. R withdraws money from his bank account, is it income? No, because income is other than a mere return of capital. Is payment by mistake considered income for tax purposes? As a general rule, payment by mistake is not taxable except if the recipient received material benefit out of their erroneous payment. Note, in CIR versus Javier, the issue raised was the imposition of the 50% fraud penalty and not the income taxation of money received through mistake. Income held in trust for another. As a general rule, income held in trust for another is not taxable since the trustee has no free disposal of the amount thereof, except if the income under trust may be disposed of by the trustee without limitation or restriction. North American Consolidated versus Burnett. When income is taxable, the following are important considerations to discover whether or not there is income for tax purposes. 1. Existence of income. 2. Realization of income. 3. Recognition of income. 4. Methods of counting. The above considerations are discussed in details below. Existence of income. A primary consideration in income taxation is that there must be income before there could be income taxation. Receipts not considered as income. Advance payment for deposit for payment. Advances are not revenue of the period in which they are received, but as revenue of the period or periods in which they are earned. Property received as compensation but subject to forfeiture. Assessment for additional corporate contributions. Increments resulting from a re-evaluation of property. Until the re-evaluated property is disposed of, there is no income realized. Parents share in the accumulated and current equity on subsidiaries' net earning prior to distribution. Money earmarked for some other persons not included in gross income. Money or property borrowed. Borrowed money has to be repaid by the debtor. On the other hand, the creditor does not receive any income upon payment because it is merely a return of capital. Increase in net worth resulting from adjusting interest. Mr. X borrowed 10,000 from his friend Mr. Y, payable in 1 year without interest. When the loan became due, Mr. X told Mr. Y that he, Mr. X, was unable to pay because of business reverses. Mr. Y took pity on Mr. X and condoned the loan. Mr. X was solvent at the time he borrowed the 10,000, and at the time the loan was condoned. Did Mr. X derive any income from the cancellation or condonation of his indebtedness? Explain. No, Mr. X did not derive any income from the cancellation or condonation of his indebtedness, since it is obvious that the creditor merely desired to benefit the debtor in view of the absence of consideration for the cancellation. The amount of the debt is considered a gift from the creditor to the debtor and need not be included in the latter's gross income. Security advances and security deposits paid by a lessee to a lessor. The amount received by the lessor as security advances or deposits is not considered income because it will eventually be returned to the lessee. Hence, the lessor did not earn gain or profit therefrom. Tourist trade and travel versus CIR. Realization of income. Under the realization income, revenue is generally recognized when both of the following conditions are met. The earning process is complete or virtually complete. An exchange has taken place. Manila Mandarin Hotel versus CIR. Note, mere increase in the value of property is not considered as income since it is unrealized increase in capital. Mr. Castillo, a resident Filipino citizen, he purchased a parcel of land in Makati in 1970 at a consideration of 1 million. In 2011, the land had a fair market value of 20 million. Mr. Ayala offered to buy the same for 20 million. Is Mr. Castillo liable to pay income tax in 2011 based on the offer to buy by Mr. Ayala? No, Mr. Castillo is not liable for income tax in 2011 because no income is realized by him during that year. Tax liability for income tax attaches only if there is a gain realized resulting from a closed and complete transaction. Madrigal versus Lafferty. Increase in the net worth of a taxpayer. The increase in the net worth of a taxpayer is taxable if it is the result of the receipt by him of unreported or unexplainable tax income. However, if there are merely shown as correction of errors in its entries in its books relating to its indebtedness to a certain creditor which had been erroneously overstated or listed as outstanding when they had in fact been duly paid, they are not taxable. Note, if and when there are substantial limitations or conditions under which payment is to be made, such does not constitute constructively realized. Recognition of income. When income considered received by Philippines income tax purposes, if actually or physically received by taxpayer or if constructively received by taxpayer. Actual vis-a-vis constructive receipt. Actual receipt. Income may be actual receipt or physical receipt. Constructive receipt occurs when money consideration or its equivalent is placed at the control of the person who rendered the service without restriction by the payer. The income is credited to the account of the taxpayer and set apart for him, which he can withdraw at any time without restriction and or condition, although not yet actually received by him, physically or reduced to his possession is already taxable to him. Example of tax income constructively received: deposits in bank which are made available to the seller of services without restrictions, issuance by the debtor of a notice to offset any debt or obligation and acceptance thereof by the seller as payment for services rendered, transfer of the amounts retained by the payer to the account of the contractor, interest coupons that have matured and are payable but have not yet been encashed, undistributed share of a partner in the profits of a general partnership. Methods of accounting. Accounting methods for tax purposes comprise a set of rules for determining how to report income and deductions. As a general rule, the law does not provide for a specific method of accounting to be employed by the taxpayer. The law only authorizes the CIR to employ a particular method of accounting of income where a taxpayer does not employ a method for computing income, or B, the taxpayer's method for accounting does not clearly reflect the income. Cash method versus accrual method of accounting. In cash method, income is recognized only upon contractive receipt of cash payments or property, but no deductions are allowed from the cash income unless actually disbursed through an actual or contractive payment in cash or property. Meanwhile, in accrual method, income is recognized in the period it is earned, regardless of whether it has been received or not. In the same manner, expenses are accounted for in the period they are incurred and not in the period they are paid. Amounts of income accrue where the right to receive them become fixed, where there is created an enforceable liability. Similarly, liabilities are accrued when fixed and determinable in amount without regard to indeterminacy merely of time of payment. Tests in determining whether income is earned for tax purposes. Realization test. There is no taxable income unless income is deemed realized. Revenue is generally recognized when both conditions are met. The earning process is complete or virtually complete, and B, an exchange has taken place, Manila Mandarin Hotel. Number 2, claim of right doctrine, doctrine of ownership, command, or control. A taxable gain is conditioned upon the presence of a claim of right to the alleged gain and the absence of a definite unconditional obligation to return or repay. Number 3, economic or benefits test, doctrine of proprietary interest. Taking into consideration the pertinent provisions of law, income realized is taxable only to the extent that the taxpayer is economically benefited. Severance test. Income is recognized when there is separation of something which is of exchangeable value. Eisner versus Macomber. All events test. Requisites. C. Fixing of a right to income or liability to pay and availability of the reasonable accurate determination of such income or liability. Q. Isabela Cultural Corporation ICC incurred professional fees for legal and auditing services that pertain to the 1984 and 1985. ICC did not claim deductions for said expenses in 1984 and 1985 since the cost of the services was not yet determinable at that time. It claimed deductions only in 1986 when ICC received the billing statement for said services. BAR, however, contends that since ICC is using the accrual method of accounting, the expenses for the professional services that accrued in 1984 and 1985 should have been declared as deductions from income during the said years, and the failures of ICC to do so bars it from claiming said expenses as deduction for the taxable year 1986. Decide. The expenses should have been claimed as deductions in 1984 and 1985. For a taxpayer using the accrual method, the accrual of income and expenses is permitted when the all events test has been met. The all events test require the right to income or liability be fixed, and the amount of such income or liability be determined with reasonable accuracy. However, the test does not demand that the amount of income or liability be known absolutely, only that the taxpayer has at its disposal the information necessary to compute the amount with reasonable accuracy. The amount of liability does not have to determine exactly, it must be determined with reasonable accuracy. The proprietary of an accrual must be judged by the facts that the taxpayer knew or could reasonably be expected to have known at the closing of its book for the taxable year. Accrual method of accounting presents largely a question of fact, such that the taxpayer bears the burden of proof of establishing the accrual of an item of income or deduction from the nature of the claimed deductions and the span of time during which the firm was retained. ICC can be expected to have reasonably known the retainer fees charged by the firm as well as the compensation for its legal services. The failure to determine the exact amount of the expense during the taxable year when they could have been claimed as deductions cannot thus be attributed solely to the delayed billing of these liabilities by the firm. For one, ICC, in the exercise of due diligence, could have inquired into the amount of their obligation to the firm, especially so that it is using the accrual method of accounting. For another, it could have been reasonably determined the amount of legal and retainer fees owing to its familiarity with the rates charged by their long-time legal consultant. CIR vs. Isabella Cultural Corp. Classification of income. As to source, gross income and taxable income from sources within the Philippines. Number 2, gross income and taxable income from sources without the Philippines. Number 3, income partly within or partly without the Philippines. Refer to discussions on classification of income subject to tax. Situs of income taxation, income from sources within the Philippines. Interest derived from sources within the Philippines. Dividends from domestic and foreign corporations, if more than 50% of its gross income for the 3-year period ending with the close of the taxable period for the declaration of dividends was derived from sources within the Philippines. 3. Compensation for services performed within the Philippines. 3. Rentals and royalties from properties located in the Philippines or any interest in such property, including rentals or royalties for the use or for the privilege of using within the Philippines. Intellectual property rights such as trademarks, copyrights, patents, etc. Gains on sale of real property located in the Philippines. 6. Gains on sales of personal property other than shares of stock within the Philippines. Gains on sale of shares of stock in domestic corporation. Income from sources without the Philippines. Interest and dividends derived from sources other than those within the Philippines. Compensation for services performed outside the Philippines. Rentals and royalties from properties located outside the Philippines or any interest in such property, including rentals or royalties for the use or for the privilege of using outside the Philippines. Intellectual property rights such as trademarks, copyright, patents, and etc. Income derived partly within and partly without the Philippines. Gains, profits, or incomes other than those enumerated above shall be allocated or apportioned to sources within or without the Philippines. Summary rules on determination of situs according to kind of income. Kinds of income: service or compensation income, tax situs, place or performance of service, rent, location of property, real or personal, royalties, place of use of intangibles, merchandising, place of sale, gain on sale of personal property, place of sale, gain on sale of real property, location of property, mining income, location of the mines, farming income, place of farming activities, gain on sale of domestic stock, income within the Philippines, interest, residence of the debtor, gain on sale of transport document, place of activity that produces the income, manufacturing. Produced in whole within and sold within, income purely within. Produced in whole without and sold without, income purely without. Produced within and sold without, income partly within and partly without. Produced without and sold within, income partly within and partly without. Dividend income from A. Domestic corporation, income within. B. Foreign corporation, if for the 3-year period preceding the declaration of dividend, the ratio of such corporation's Philippine income to the word total was less than 50%, entirely without. 50% to 85% proportionate, more than 85% entirely within. Formula: proportionate, Philippine gross income times dividend received, income within, entire gross income. Gross income, except when otherwise provided. Gross income means all income derived from whatever source, including but not limited to the following items: 1. Compensation for services in whatever form paid, including but not limited to fees, salaries, wages, commissions, and similar items. Gross income derived from the conduct of trade or business, or the exercise of a profession. Gains derived from dealing in property. Interests, rents, royalties, dividends, annuities, prizes and winnings, pensions, and partners' distributive share from the net income of the general profession partnership. The above enumeration of gross income under NIRC is not exclusive. Concept of income from whatever source derived. Under Section 32, letter A of the NIRC, gross income means all income derived from whatever source. Income from whatever source includes all income not expressly included or exempted from the class of taxable income, irrespective of the voluntary or involuntary action of the taxpayer in producing the income. Gutierrez versus CSCIR. Therefore, the source is immaterial. Whether derived from illegal, legal, or immoral sources, it is taxable. As such, income includes the following among others. 1. Treasure fund. 2. Punitive damages representing profit lost. 3. Amount received by mistake. 4. Cancellation or condonation of the taxpayer's indebtedness. 5. Receipt of usurious interest. 6. Illegal gains. 7. Taxes paid and claimed as deductions subsequently refunded. 8. Bad debt recovery.